Blog Talk Radio.
Join BluPrint Radio each Tuesday, 7 p.m. Eastern. BluPrint Radio host Gloria Thornwell interviews organization leaders on trends and best practices in business and human capital management, business and human resource leadership, and being a change champion in the new global business economy. www.blogtalkradio.com/BluPrint LLC.
Hi, and welcome to BluPrint Radio. BluPrint Radio is a division of the BluPrint Leadership Institute, and on the BluPrint Radio show, we interview organization leaders and change management professionals who are subject matter experts in human capital management, business strategy, government contracting, and those who have reinvented and led organization transformation in the new global and changing economy. I'm Gloria Thornwell, your human resource and management consultant and your BluPrint Radio show host. On a previous episode, we talked about taxes. In particular, we talked about taxes for small businesses and for the self-employed. We noted that to reduce the amount that can be taxed on business profit, it's important to understand how to maximize deductible business expenses. We talked briefly about tax laws, specifically about Section 162 of the tax code, and then we briefed our listeners on what the IRS considers legitimate deductible business expenses. Then we moved into tax planning and declared that tax planning really is a year-round event and that it is critical that business owners keep all business-related receipts, records, canceled checks, and other documents categorized by expense type. On today's BluPrint Radio show, we're happy that Antwan Anderson will join us again to talk a bit more about taxes. This time, however, our focus and our emphasis will be on corporations. Antwan is president and CEO of Anderson & Company, a multidisciplinary tax, accounting, and management consulting services firm. Welcome back, Antwan, to BluPrint Radio. There are many variables to ensuring that corporations are compliant with tax law, and in particular because tax laws change so frequently. There are tax brackets for corporations as similar to tax brackets for individuals and for families. Many corporate executives don't fully understand taxation and ponder questions sometimes in topics such as double taxation, stock-based compensation, how stock-based compensation is taxed, and then, of course, dividends and shareholder tax payments. We're going to go to a short commercial break, but when we return, we're going to talk to Antwan Anderson. He's a tax expert, but also president and CEO of Anderson & Company, and he's going to talk about taxes for corporations. So stay tuned, and we'll be right back.
Did you know that when you take a BluPrint Leadership Institute course, you can earn credits toward your PHR, SPHR, and GPHR recertification? The BluPrint Leadership Institute is certified by the Human Resource Certification Institute and by the International Accreditation Organization. Earn CEUs in project management, finance, executive development, and in other disciplines that will keep you current as a 21st century business leader. Register today. www.blueprint-llc.com.
Welcome back to BluPrint Radio. I'm Gloria Thornwell, your BluPrint Radio show host. And our guest today is Antwan Anderson, president of Anderson & Company, a tax, accounting, and management consulting practice. Hi, Antwan. We're glad to have you return to BluPrint Radio. And, again, welcome. Let me just make sure that you can hear us. Give me one moment here. Antwan, can you hear us?
Yes, I can. Can you hear me?
I can.
Okay, great. Glad to have you.
Thank you so much. Thank you so much for returning back to BluPrint Radio. We're glad to have you back on our show. So without further ado, I'm going to move right into our questions, if that's okay.
Yes, it is. Thank you.
Excellent. So my first question is, let's talk about double taxation. What's that mean?
Double taxation is when you are paying on a business level at a corporate level, then you also have to pay as an individual on your personal level. So corporations, closed corporations are taxed, and you pay at that level on a corporate side. But then also the compensation, as far as the compensation part, comes over to your personal side, and then you're paying over there as well on your personal individual tax levels.
So does the president and CEO have to be on the payroll books for a corporation?
Yeah, this is a very, as they say, fine line to walk on. The IRS encourages and wants to see an individual that owns a corporation to be on payroll. Now, they can take a distribution from the corporation, but you have to prove that you have basis in that corporation to be able to take those distributions out. If you do not and you go below the basis, then when you take any monies out of your company, then you have to pick that up on your tax return, be it if it's taken as a draw, as a distribution, and of course if you're on payroll, then you're going to receive a W-2 at the end of the year. But it's encouraged that an individual does receive a W-2 because a corporation is its own separate entity, separate than an individual, such as a sole proprietorship, LLC, or general partnership.
So in a corporation, when the president and CEO is on the payroll, he or she, I guess my question is, can he or she take a distribution and get a salary, or is it one or the other?
No, they can do both, actually. They can be on salary, and then at some point during the year, they can take out a distribution. Generally, that distribution could say at the end of the year, I want to take a distribution out to take care of whatever that may be, to pay whatever it can be. Now, the key point to that is that as a corporation, because it's a separate entity, you want to document that you have discussed that with the board of directors, even if you are board of directors of one. You still, or you're elected not to have a board of directors, you want to document something to show that you have elected to do that. If you're on an accrual basis, a lot of companies or corporations have that meeting prior to the year end and may say, I want to take a distribution, and be it a bonus, I can do it that way, or make a charitable donation, and you can make that donation or take that bonus after the year end as long as you do it before March 15th when the corporation is due. That way you may receive monies in the next year but still be counted as a deduction in the prior year.
I'm glad you talked about bonuses because that was going to be my follow-on question. A distribution can be in the form of a bonus. So say they had a really good year in terms of profit, and the officers and the board, I guess, vote on certain bonus amounts for officers, presidents, whomever. It's considered a distribution, but you may call it a bonus.
Correct. That is true. You may call it as a bonus, but keep in mind, what you do for yourself as the owner of a company or a corporation, you must do for your employees. So if you elect to take a bonus of $25,000 as an example, you don't necessarily have to give your employees $25,000, but you have to give them a bonus as well. So you can't make a bonus out for yourself and you're on payroll and then turn around and say, I'm only going to give my bonus just to me, just to satisfy me. What you do for yourself, you have to do for your employees as well.
Which makes only good sense, good business sense, and it's the right thing to do.
Absolutely.
What is a PSC corporation?
A PSC is a personal service corporation. Now, that corporation is a corporation that is really geared toward persons that does activity in the fields of accounting, actuarial type work, architecture, consulting, engineering, health, law. Those are personal service corps. And one thing to keep in mind with that, the key piece is that you will be taxed if you are a closed corporation at 35%, and that's a flat tax, as opposed to you being an S corporation and that profit or loss comes over to your personal tax return and you pay at your personal tax levels. So a lot of corporations that are considered a personal service corp, they must weigh the difference between what's the tax advantages and also the non-tax advantages of being a personal service corp, or should they be an S corporation, or, as we spoke about last week, being a limited liability company or limited liability partnership.
What are corporate tax rates? Can you tell us a little bit about that?
Sure. As I was saying before, a personal service corporation is taxed at a flat 35%. That's separate from a closed corporation. A closed corporation has multiple levels of tax rates. From 0 to 50,000, they're taxed at 15%. From 50 to 75,000, they're taxed at at 25%. And then from 100,000 to 335, they're taxed at 39%. And I skipped one, I'm sorry. From 75,000 to 100,000 is 34%. And it goes on such as that. So what you have to do is keep in mind that there's a closed corporation and they're taxed at those growing levels. A PSC, which is a personal service corp, is taxed at a flat 35%. But a subchapter S corporation, which is an S corporation, does not pay any taxes at all, and that K-1 that you will receive for the profit will roll over to your personal tax return, and you're taxed at those personal levels.
We're going to take a short commercial break, and when we come back, we're going to continue our discussion on corporate taxes with Antwan Anderson, president of Anderson & Company. We'll be right back.
Did you know that when you take a BluPrint Leadership Institute course, you can earn credits towards your PHR, SPHR, and GPHR recertification? The BluPrint Leadership Institute is certified by the Human Resource Certification Institute and by the International Accreditation Organization. Earn CEUs in project management, finance, executive development, and in other disciplines that will keep you current as a 21st century business leader. Register today. www.blueprint-llc.com.
Welcome back to BluPrint Radio. I'm Gloria Thornwell, your BluPrint Radio show host. And Anderson is our special guest, and today we're talking about taxes for corporations. And so my next question is about S corporations and a closed corporation. Is there one that's better or best than the other?
It just depends on which corporation is best for the type of activity that you're working in. You want to not only look at the tax implications of being an S corporation versus a closed corporation, but also the type of activity and the outside tax ramifications that could come into play. So which one works best for you? I'll give you two quick examples. As I was saying, as an S corporation, you do not pay taxes, but as a closed corporation, you do. So are you a personal service corp that will be taxed at the 35% or at the regular tax rates, as I was explaining before, at 15, 35, and 34%? 15, 25, and 34, and 39%, and so on. The other side of that is, what are some non-tax issues that come about when you're attempting to buy a house, as it is very difficult for you to receive a mortgage loan, or you pay sometimes at a higher rate, or you receive a higher interest rate because of the risk factor as a LLC or a sole proprietorship. But if you're a corporation, you have the ability to be on payroll, which now gives you more room to be able to work your loans a little bit better and receive, because you're receiving a W-2 and not as opposed to a draw or a distribution.
So can you talk to, I'm going to switch it just a little bit. Can you talk a little bit about stock-based compensation? So stock-based compensation, I guess, generally consists of either transferring stock or something like that. So can you tell us what it is and how is it taxed?
Sure. Stock-based compensation is generally when you issue stocks for a corporation under ISO or ESOP, which is employee stock options or incentive stock options, and they give those out. Let me give you an example. It's generally given to a lot of startup companies, And it's a great way to give incentives for new CEOs and executives and basically not pay out any money from your cash and disturb your cash flow, but it gives them the ability to receive stock compensation and stock options for future value so that the company will grow. And generally, you do not pay taxes when you receive those stock options. The key thing to keep in mind, though, is that whether those stock options will be forfeited at some point in time, because that changes the tax levels and the way it's going to be taxed. Now, eventually down the line, when you do pay the taxes, you have to keep in mind if you're going to have to pay alternative minimum tax, which is the difference between the fair market value of the stock at the time it's exercised and the exercise price of the option when you purchased it. When you received it. So stock options and stock-based compensation is a great way for you to receive incentives as an executive and owners of a corporation, but just keep in mind of the tax ramifications down the line. But there are none initially when you're receiving those stock-based compensations at that time.
So let me just make sure I'm clear. So stock-based compensation then is, so if it's a new small company and you get investors to help fund the company, at its startup, and then, as you said, there's sort of some future value of there's a future value attached to it. So once the company grows and gets to a certain point, then the investors are paid out via stock-based, what's called stock-based compensation. Is that in line with what you were saying, or is that different?
A little different. What happens is in the initial beginning, you receive those stock options as down the line that you can receive those for a future value. And what happens is down the line, when you exercise those stock options at some point in time, be it a year, 2 years, 5 years later, those stock options has a value at that point. And at that point, that's when you're going to be taxed off those and could be subject to alternative minimum tax.
Makes sense. So talk to us then about shareholder tax payments and how that works.
Yeah, shareholder tax payments, as a S corporation, you can receive monies as far as via payments from your corporation as a distribution, or you may receive dividends and things of that nature. When you receive that compensation, you have to pay, of course, your tax payments as a shareholder from those monies that you receive, and those monies are taxed depending on your tax level as an individual at your individual tax rates. So and they're different. Dividends carry a capital gains tax level, whereas other payments will be taxed on your individual tax rates at 15%, 25%, or 34%. So those payments should be paid via estimated tax payments, as we discussed last year, which are 4 times a year, which is April 15th, June 15th, September 15th, and January 15th of the following year.
We're going to take a short commercial break, and when we come back, we're going to continue our discussion, Taxes for Corporations, with Antwan Anderson, President of Anderson & Company. We'll be right back.
Did you know that when you take a BluPrint Leadership Institute course, you can earn credits toward your PHR, SPHR, and GPHR recertification? The BluPrint Leadership Institute is certified by the Human Resource Certification Institute and by the International Accreditation Organization. Earn CEUs in project management, finance, executive development, and in other disciplines that will keep you current as a 21st century business leader. Register today. www.blueprint-llc.com.
Welcome back to BluPrint Radio. Today's topic is taxes for corporations. I'm Gloria Thornwell, your radio show host, and we're talking with the President of Anderson & Company and tax expert Antwan Anderson. Antwan, my next question is about tax on dividends. So how does that, what is it and how does it work?
Tax on dividends are dividends, when you receive from a corporation, you receive dividends for some of the gains that you receive in monies from your investments in the stocks. You receive those dividends, and they are in the form and given to you in the form of a 1099-B. And you report those dividends on your personal tax return, and you are taxed on the capital gains tax rates. Those capital gains tax rates can be 15% or 28%, and depending on the tax level that you're in, sometimes if you're on the lower tax level, it could be 0% if it's short-term or things of that nature. And they're categorized between short-term and long-term. So those dividends yields monies back to you, and you're taxed at that level on the personal tax rates. Now, keep in mind, if you are owner of stocks and you have it in a company, you can also request to have your dividends reinvested into the company. So it keeps as another form of money you're putting as you're buying additional shares, and you're able to continue to gain your money within those within that company through its value by reinvesting your dividends.
And so that could be stocks, it could be mutual funds, is that right?
Absolutely. It can be mutual funds and stocks, and I just want to reiterate one little piece for any investors that's going in. Think of stocks and mutual funds as being a bowl of M&Ms. If you lose your money in the stock market, you can dump out all those M&Ms, and you have lost all those, or you pile them in and you've gained them. If you have an investment in mutual funds, think of it as a multiple of different companies. So if one company loses, you take one M&M out the bowl, but you still have the other ones in there that can potentially gain your money.
Talk to us a little bit about retained earnings and taxation.
Yes. Retained earnings is the makeup of your earnings and profits, and also your losses that come from the operations of your business on an annual basis. Now, retained earnings is the cornerstone of whether you have value in your company and whether you have the ability to invest and receive loans. They look at your retained earnings if it's working at a positive and not a negative. And retained earnings is the accumulation of those earnings and profits. Now, you're not taxed on a retained earnings, but you are taxed on the net profit that adds to your retained earnings. And if you have a loss, vice versa, it will lower your retained earnings. Negative retained earnings generally means that you have no basis in your corporation or very little basis in your corporation. That takes on a whole nother light, that now any monies that you take out of your corporation, you will have to pick that up as income, because you cannot take it as a distribution. It must be picked up as income, and you must pay taxes on it because you have negative basis in your corporation.
Wow. Well, let me ask you this. Talk to us a bit about fringe benefits. So is that considered a deductible expense, a corporate write-off? How does that work?
Sure. Fringe benefits are the make up a variety of things. You can have a cafeteria plan, which is a Section 125 plan that has a multitude of different fringe benefits within inside of it, be it your health insurance or insurances, life insurance, and things of that nature. Your fringe benefits can also include your retirement package, be it the 401k or your different retirement plans that's available to a corporation or to businesses. And yes, those are deductible. You can have a contributory plan, a non-contributory plan as a retirement, and that means that the corporation is contributing towards your retirement plan to the employee's retirement plan, or it can have a non-contributory that they do not contribute toward those. But any monies that's paid out by the corporation for the retirement plans or the fringe benefits is a deductible expense for the corporation.
So let me just kind of go over something you just mentioned. So there could be, and this may not have anything to do with taxes per se, but there is a retirement plan that organizations or companies can offer to the employees where the corporation or the organization does not contribute. It's employee contribution only. Is that what I heard you say?
Yes, there is a plan such as a contributory plan and a non-contributory plan. I am not a financial advisor, so I will always suggest that you seek a financial advisor to give you more explanation, but I will say that those plans, as a contributory plan, the corporation is contributing toward the employee's retirement, such at 1%, 5%, or up to 6%, and they will set up various plans based on that. Or they can have a non-contributory plan that the employee contributes toward their retirement account, but the corporation does not put any monies toward those. And there are certain laws and regulations that you have to follow to make sure that you adhere to the right things to be able to do those contributory and non-contributory plans.
So, Antwan, listen, we are out of time, unfortunately, and the reason we invited you back is because I enjoyed our time so much on our last show, and this has been another really great show. So we want to thank you for returning to BluPrint Radio. And, again, you've helped our listening audience learn more about taxes, this time about corporate taxes, including how business formation affects the organization's tax liability. You've talked about dividends, retained earnings, fringe benefits, and all the great tips and just, know-hows for organization leaders. So we appreciate your time today. And if you wish to share with our listeners how they might contact you, feel free to do so now.
Absolutely. Thank you very much to BluPrint Radio and to you, Gloria, for allowing me to come back onto the show. I do want to make sure I state one thing correction that I stated last week in reference to Section 179. The Section 179 limit is $500,000. It has reverted back down to $25,000, but we do anticipate the Internal Revenue Service allowing that to be substantially increased. I wanted to say that. I can be reached at 410-363-9510. I'm located at 400 Redland Court, Suite 105, Owens Mills, Maryland, 21117.
Thank you again, Antwan, for joining BluPrint Radio for a second time. To learn more about BluPrint, you may visit